Welcome back to the deep dive. Today, we're doing something a bit different. We're putting on our historical crash helmets
Right.
because we're taking, a massive shortcut through literally centuries of financial mayhem.
Yeah, our sources cover market volatility from way back, like the 1600s, right up to today.
And the goal here is to get you, our listener, instantly well-informed. A cheat sheet,
That's
almost.
right. The mission is pretty critical.
Mm.
Cut through all that noise, all that chaos.
Hmm.
We want to look past the specifics, past which asset collapsed or who was in charge at the time,
And focus on.
and focus on identifying the few consistent recurring warning signs, the things that seem to pop up every single time before a major financial collapse.
It's fascinating, isn't it? When you really look across the centuries. I mean, tulips in the 1600s, algorithms now.
The underlying errors, human and structural, they're just shockingly repetitive.
It's almost, comforting in a weird way. The pattern doesn't really change that much.
And recognizing that repetition is absolutely crucial for you, the modern investor. If we can see the signals from the past, we stand a much better chance of, navigating what's coming.
Okay.
So we've boiled down the source material, synthesized it into four primary factors, four things that just keep showing up in every big collapse.
All right, let's unpack this then. These four recurring patterns. Where do we start? What's the first domino, usually?
Well, it almost always starts with the psychological driver, the ingredient that kicks the whole mess off, sometimes before the technical stuff even breaks down.
Okay.
That brings us squarely to pattern number one: irrational exuberance and rampant speculation.
Irrational exuberance. Greenspan's famous phrase.
Exactly. And this isn't just, normal market optimism. This is different. It's like a collective delusion, a widespread belief that the normal rules of risk and valuation just don't apply anymore.
But hang on, speculation's always part of the market, isn't it? I mean, how do you tell the difference between, say, rational speculation like betting on a genuinely promising new tech and this irrational kind that leads to disaster?
That's a great question. The key distinction really lies in the disconnect. The disconnect between an asset's fundamental or intrinsic value and what people are actually paying for it.
Okay.
When the underlying belief shifts from, say, this company has good prospects, it will probably earn money, to something like, I don't care about earnings, someone else will definitely pay more for this later, guaranteed.
Yeah.
Well, you've crossed that line.
Right, it becomes a game of hot potato.
Precisely.
Yeah.
And the classic, almost pure historical example of this is the Dutch Tulip Mania
Yeah.
back in the 1630s.
Ah, yes, the tulips. It seems almost unbelievable now because it was just flowers.
Exactly. No complex derivatives, no central banks meddling.
Yet the economic damage was very real.
Oh, absolutely. The sources point out that at the absolute peak, some single rare tulip bulbs were trading for more than a house in Amsterdam. People weren't buying a flower, were they? They were buying the expectation of just limitless profit. Pure speculation.
And the crash. It wasn't bad policy or anything.
No, it was simply the sudden collective realization that a tulip bulb is, after all, just a tulip bulb. The spell broke.
So the first component is internal. It's this widespread investor overconfidence that just pushes aside normal caution, normal due diligence.
That's the starting point.
It's humbling, really, that the first thing to go wrong century after century is just our own shared confidence. Okay, so once that psychological wave peaks, that's when the more mechanical structural failures start to come into play.
That's often when the market system itself starts to show its cracks, yes. If emotion kicks it off, the system itself can, help the disaster along.
Right. Let's transition then. The next two warnings you mentioned are closely linked.
Very tightly linked. They often work together.
Okay, so the first of these mechanical failures, pattern number 2, is regulatory lag and shortcomings.
Yes. This basically means government oversight, the rules of the game, just failing to keep up with what's actually happening in the markets.
How so?
Well, historically, financial innovation and, let's be honest, human ingenuity in finding loopholes moves much, much faster than regulators or legislators can possibly write new rules to manage the risk.
So the market evolves, maybe creates whole new ways of trading or investing, and the rulebook is stuck in the past, leaving these huge blind spots.
Precisely. You saw this incredibly clearly leading up to the Great Depression.
1929.
Yeah. The failures exposed them were so profound, so deep, it took creating entirely new regulatory bodies like the SEC and landmark laws like Glass-Steagall just to try and rebuild confidence and structure.
And all that building happened after the crash.
Exactly. The lag between financial evolution and the regulatory catch-up is always, always expensive.
Yeah.
Someone pays the price for that delay.
Okay, so that's a regulatory failure. But you said he's a partner in crime.
Often, yes, it's often not enough on its own. Which brings us neatly to pattern number 3, the emergence of a new, poorly understood innovation.
Ah, the mystery machine component you mentioned earlier?
Yes. It's a really consistent feature.
Yeah.
Every major collapse seems to involve some kind of financial tech or a new tool or a strategy that's, well, new, confusing.
And people don't really get the risks.
Exactly. The actual systemic risk profile is widely underestimated. Not just by investors, but often by the regulators themselves who are trying to play catch-up, remember.
When you say innovation, are we talking big things like, I don't know, blockchain today?
Yeah.
Or more behind-the-scenes stuff?
It can be both, but the sources often point to more technical, maybe less flashy things initially. Think about portfolio insurance back in the 80s.
Right, Black Monday.
Or the really complex mortgage derivatives in the mid-2000s. Let's stick with portfolio insurance for a second, though, because it illustrates the danger perfectly. Leading up to the 1987 crash, Black Monday, this portfolio insurance was a new, fairly complex trading strategy, often algorithmic even back then.
And the idea was to protect big portfolios.
Yes, protect them by automatically selling stock index futures if the market dropped past a certain point. A kind of automated hedging.
Sounds sensible on the surface, like a safety net.
It did. But here's the catch, the pattern 3 problem.
Yeah.
What nobody fully grasped was what happens if everyone starts using the same automated selling strategy at the exact same time. It stopped being insurance and became a massive market accelerant, a downward spiral.
A feedback loop.
Exactly. The market starts to fall a bit, the algorithms automatically trigger huge sell orders, way more than humans could execute manually, which pushes the market down further, triggering more automatic selling.
And you get a crash, a 22% drop in one day.
Bingo.
What strikes me here is how the complexity often masks the risk. People think, oh, it's complicated, it must be sophisticated and safe.
When, in fact, the complexity might just mean nobody truly understands the potential systemic impact when things go wrong. It's a black box.
So that combination, pattern 2, the regulatory lag, and pattern 3, this confusing new tool like portfolio insurance, that sets the stage.
It really does.
Yeah.
You have lax oversight, or maybe no oversight, of a new technology that can move markets faster than anyone can possibly react. It's a recipe for sudden shocks.
Okay, so we have the psychology, the overconfidence, we have the systemic weaknesses, the slow regulations, and the confusing new tech. But these 3, even together, need something else, right? They need fuel to turn a market drop into a real inferno.
And that fuel, that brings us to the final and absolutely crucial pattern number 4, the pervasive and massive buildup of debt, leverage.
Right. This feels foundational. This determines how bad the pain gets.
It really does. Look, markets always correct eventually. Prices go up, they come down. But it's the level of debt in the system that determines whether a simple dip becomes a truly catastrophic system-wide failure.
How does that work exactly?
Well, when debt levels, whether it's families borrowing too much, companies taking on huge loans, even governments reach a massive scale relative to the underlying economy, the whole system becomes incredibly brittle, fragile.
Okay.
So when asset values inevitably start to drop, the leverage from all that debt means the losses just multiply incredibly quickly. And they spread like a contagion from one part of the economy to the next, a cascading effect.
And the definitive modern example has to be the 2008 housing crisis.
Oh, absolutely. It's almost a textbook case study connecting all 4 patterns.
Lay it out for us.
Okay. You had a massive overconfidence in housing prices, always going up. That's pattern 1, irrational exuberance.
Yep.
You had significant regulatory failures, particularly in overseeing the mortgage industry and the big banks, packaging those mortgages, pattern 2.
Right, the oversight lag.
Then you had the accelerant, the poorly understood financial innovations, these incredibly complex derivatives like CDOs, synthetic CDOs, the mystery machines of that era. That's pattern 3. But the scale of the collapse, why it nearly took down the entire global financial system, was only possible because of pattern 4. The absolutely monumental accumulation of debt, millions of mortgages, layered with corporate leverage used to trade those mortgage-backed securities.
So connecting it all, Debt is the amplifier.
It's the foundational amplifier. Exactly.
Yeah.
If that 2008 correction had happened without those trillions upon trillions in leveraged debt woven through the system, sure, it would have hurt the housing market, maybe caused a recession.
But it wouldn't have frozen global credit markets.
Very unlikely. Debt is what makes the inevitable correction potentially catastrophic.
This is brilliant. We've kind of time traveled through centuries of financial history and pulled out these 4 core ingredients: the euphoria, the regulation lag, the confusing new tech, and the underlying excessive debt.
That's the framework.
So the million-dollar question then. What does this all mean for you, our listener, the modern investor? How do we take this historical roadmap and actually use it practically right now?
Well, the primary value here, the main takeaway from the sources, is really about preparation, not prediction.
Oh, okay.
Since these 4 patterns are so consistently recurring, you can actively look for signs of them developing in the current market environment.
Right, so let's break that down. How would someone listening now try to monitor these? Let's start with pattern 1, irrational exuberance. How do you spot that today? Is it just looking at the VIX index or?
Sentiment indicators can be part of it, sure, but it's also about listening to the language used around market darlings, around the big winners.
Like what?
When you start hearing justifications like, oh, this time is different, or when assets, especially speculative ones, are valued purely on sort of future narratives or potential disruption rather than any current earnings or traditional metrics,
Yeah,
that's a strong signal for pattern 1 building up.
got it. What about the system stuff? Pattern 2, the regulatory lag, and pattern 3, the new innovation. Those seem harder to track, especially if the tech is super complex.
They are harder, but not impossible. You track the areas where financial innovation seems to be clearly outpacing regulatory understanding or oversight.
For instance.
Well, think about the sheer speed and complexity of modern algorithmic high-frequency trading. Or consider entirely new decentralized asset classes where regulators themselves openly admit they're struggling to even define the risks, let alone regulate them effectively.
So if the watchdogs are scratching their heads.
That's pattern 2 and 3 potentially brewing together. You, as the listener, should ask, does this hot new investment tool or platform rely on mathematical models or code so complex that very few people truly understand how it works under stress? If the answer is yes, it carries that potential pattern 3 risk, the mystery machine risk.
Okay. And finally, the fuel pattern 4, the buildup of debt. That feels like maybe the hardest for an individual to get a grip on. It's macro stuff.
It is macro, but you can still monitor the general health. Look at broader economic indicators, things like corporate debt levels compared to their equity or overall household debt compared to national income.
Are there red flags?
When you see those ratios hitting historically high levels, maybe records, that tells you the system is becoming brittle again. That structural weakness means any correction, when it comes, is likely to be more severe because of pattern 4.
So recognizing these patterns isn't about timing the market perfectly, but about building resilience before a shock eventually hits.
Precisely. Preparation.
What are the specific proactive actions the source material advises based on this understanding?
The core advice is really twofold. First, focus on strengthening your own financial resilience. Primarily, this means finding ways to increase or diversify your income streams.
Why income specifically?
Because a reliable income stream is probably the best personal hedge against asset price volatility. It keeps you stable when markets aren't.
Makes sense. And the second piece of advice?
The second, and maybe the most critical, is about psychological preparation. It's about understanding this cycle so you can avoid the single most common and usually most damaging reactive mistake people make to volatility. Panic selling. Selling everything off when the market plunges.
Because that just locks in your losses.
It locks in the losses, and it almost guarantees you miss the eventual recovery, which history shows always follows, eventually.
Right.
So the real benefit of this deep dive of understanding these patterns is knowing that volatility is normal. It's guaranteed. And when the next significant downturn happens, the underlying reasons will almost certainly be traceable back to some combination of these 4 factors.
And knowing that helps you stay calm, stay the course, avoid those gut reactions.
Exactly. Preparation, not panic.
This has been incredibly insightful. A whirlwind tour of market history, but with a clear purpose. Let's quickly recap those 4 recurring warnings one last time.
Okay.
First, widespread overconfidence and speculation, the psychological driver. Second, regulatory failure, the rules not keeping pace with the market.
Right, the lag.
Third, the use of poorly understood, often complex financial innovation, the mystery machine. And fourth, the foundational fuel, the pervasive buildup of debt that amplifies any collapse.
That's the set.
We've covered centuries of financial trauma, distilled it down. Now, as we wrap up, maybe a final provocative thought for our listeners to chew on, building on that mystery machine idea.
Okay, let's try this. We know portfolio insurance was the poorly understood innovation back in '87. We know complex derivatives played that role in '08.
Right.
So think about today. Think about the incredibly rapid growth of AI in trading, complex machine learning models setting prices, maybe even highly decentralized financial systems operating largely outside traditional oversight.
Okay.
The question for you to consider is, what modern financial innovation, widely used but perhaps not fully understood systemically, could potentially be the portfolio insurance of tomorrow? What's the complex element today that might accelerate the next downturn when stress hits?
Something to definitely mull over as you keep an eye out for those 4 historical signals in today's market.
Food for thought.
Thank you so much for joining us for this deep dive into market volatility. We hope you can use the synthesized knowledge to stay well informed and maybe more importantly, well prepared